kind of go over what's happening in this market. First, we're going to talk about bridge loans. So bridge loans have been very, very popular. And I want to make sure you understand the different strategies that are out there with bridge loans. So I'm going to go through a few different strategies and a few different methods that you can help prepare your buyers and sellers when they're looking to purchase a new home, but are doing so before they sell their current home. So I'm going to go over those strategies for you real quick, and let's look at some scenarios. So here's a typical scenario that we see. They've got a house that's really small in California, and they're moving to Arizona, buying a bigger home, and it's for the same price. So we're looking at let's just pretend they have a $500,000 loan over here. They want to buy this house, the new home in Arizona, before they sell. So what are their options? Because all they have is about $100,000 in cash, and they want to bridge this over. They don't want to be burdened by the payment of this, but they want to use the equity to purchase the new one. So how do we set this up? Well, a typical bridge loan is actually quite expensive, but here's how it works. So the new loan, we will create a new loan that's on their departing residence. So if they owed $500,000, we would do a much bigger loan and at 80% of the value of that house. So in this case, if it's worth $950,000, you'd be getting about a $760,000 loan. That means in their hands, they will have $260,000 in cash. We would have a new mortgage on the home that they're going to be selling for much bigger at $760,000. And they would use that $260,000 towards the down payment on the new house. Now, the nice thing about a true bridge loan is the payments on that new mortgage on the home they will be selling, they will not need to make any payments on that new big mortgage of $760,000. The payments are going to be rolled into the loan. So there's no double payments in a true bridge loan. Then put the money down on the new home. We put a new mortgage on the new home, another one on the purchase. And then once they're in that house, they can sell. They have up to a year to sell the house that they're departing. And then once that sells, those liens will be paid off, and then they're left with their permanent mortgage on their new home. So now that's a true bridge loan where you don't have to count any of the payments against them. The problem with bridge loans is this. Mortgage companies need to make money on a loan. And if it's going to be a loan that's paid off like that, there's zero money to be made. And in fact, there's a loss because they have to set up the servicing, they have to set up everything, and then the loan gets paid off, and they never made any interest on it. So all bridge loans are very expensive, and they usually have a couple points up front to do a bridge loan. So in this case, you're talking about $15,000 in extra fees to do a bridge loan, a true bridge loan. So a lot of people don't like this because they see the fees and they're like, oh, I figure something else out. And that's where the next slides come into play. So first off, any questions on a true bridge loan? It's pretty straightforward, but if you do have any questions, jump into the chat and then I'll answer those towards the end. So let's just say you want to buy the new home. You've got a home you're going to sell, but one other thing on the bridge loan, I don't know if I told you this, you don't have to count the payments against that in qualifying. So when qualifying for the new mortgage, you don't have to be hit with that big payment on the departing residence at all. All of the taxes, insurance, and mortgage on the departing residence, you do not have to count that payment against you when qualifying for the new home on a bridge loan. So it's easier to get approved using a bridge loan than a different type of method, and we'll go over those right now. So this is where, if you're a listing agent and you are going to be listing their home for sale, you want to have this as part of your conversation. If you're going to be using the equity from that home to purchase another property, you might as well set up the biggest home equity line you can to enable you to use that equity to buy a new home right away. So you may not ever use it. And the nice thing about a home equity line is if you don't ever use the home equity line, which most of them are free, by the way, If you don't use it, you don't make any payments. It's just nice to have just in case you find a home that you want to buy before your house sells. It's just another tool. If they find the dream home, but they haven't listed their home yet and they want to buy that dream home, and you're now doing that listing presentation, you're like, well, you can't buy this. Let's set up a home equity line before we list it, because once you list a property for sale, there's no more traditional mortgages that can be had. So have that conversation with a home equity line at the beginning, and you can use that cash in a home equity line for the down payment equity, and you applying that towards your purchase. But this scenario, you have to count the payments against you on the loan you had, the home equity line, and the new loan you're trying to get. So this scenario is a little bit harder to qualify for, but it's a little cheaper because there's no cost for a home equity line, and you don't have the high fees that are involved with a bridge loan. Now, once you in that home and you sell this property, your normal mortgage on your new home. If there's any other proceeds that you wanted to apply towards that new house, because the loan may be a little bit bigger than you wanted, you can do a loan recast, which is basically a large sum of money put up front in towards principal, and then we recalculate the payment. The loan terms stay the same, but we just recalculate the payment to give you a nice lower overall payment. And that's called a loan recast. Different than a refinance, because I call that the mini bridge, using a home equity line to buy the new one. Again, the only challenge is that you have to count all of the payments on the mortgages against that person when qualifying. So that's the home equity line on the departing home. Now, the next
Sean,
one, yes.
if you can hear me, you have frozen a couple times. So if anyone has any questions about what he said or missed anything, let us know. It was just for brief seconds. So
Okay.
you're back. I think it's good. So just wanted you to know that.
A home equity line to purchase a new home. Now, this is my favorite scenario, and it's called the piggyback bridge. So most people have some sort of cash during the process. So they have maybe 10% down somewhere, maybe in a retirement account, maybe in their savings account, in a 401k that they have access to. Make sure there's no penalties. And then we use that 10%. The first mortgage. So first of all, we calculate how much equity, how much they're going to net from their sale. Okay. So if they're going to net 350,000 from their sale, we're going to set up two mortgages. A second mortgage that is equal to whatever they're going to net on the sale of their home, and then a first mortgage for that difference. So we're going to finance 90% of the property. The first mortgage is going to be whatever the permanent loan is going to be. The second mortgage is how much equity they're going to net from the sale, and then the 10% down of their own money. Now, once that home sells over here, they're going to use the net proceeds to pay off the second mortgage. So when we do the purchase, it's just going to be a traditional purchase. We'll do maybe a first at 60% of the purchase price, a second at 30% of the purchase price. So that's 90% of the purchase is financed. And then they'll have their own 10% down. Then when their home sells, they can go ahead and pay off that second mortgage and be left with a final mortgage in place at the lower loan amount. So that's what I call the piggyback bridge. We do this quite a few times. It's a great way. It's simple. There's only one transaction needed. Instead of doing a home equity line, getting approved from that, and doing a permanent mortgage, or doing a bridge loan and the permanent mortgage, this is just a one step. It's a lot cheaper and a lot of times easier. Mortgage you still have and the new mortgages together. So that's the piggyback bridge. I love this option, and we use this quite a few times. Any questions? All right. My connection is unstable. That is fantastic. Well, hopefully I'll still stay connected, but here's the current candlestick charts. Our down, and now we're really flat. Not much movement whatsoever. And now that's a good thing. We're creating a really strong floor of resistance down here. So hopefully we'll stay above this and we'll continue to see really good rates as we move into September. And then once the Feds start their cuts, we're going to see rates continue to get better. And then here's the 10-year a floor. So it's not bouncing above this. It's got a nice ceiling, I call it. And then hopefully we'll get that to continue to move down as well. So mortgage rates are in the mid sixes right now for the perfect buyer, a little bit lower on the 10-year or 15-year mortgage. And we're in a good position, and a lot of buyers are now coming off the fence. So excited to finally see that. We have a really quiet week, We have the Feds talking. We do have a bond auction on Wednesday. And remember, these bond auctions are pretty messy lately. So we could see on Wednesday some deterioration in the rates. So hopefully we won't see that. Hopefully it'll be a good bond auction, but the track record for these for the last several months has been pretty bad, and that's causing rates to stay higher. So we also have the Fed minutes coming out on Wednesday, and then we have initial jobless claims on Thursday. And we've got our Fed Mr. Powell going to be speaking on Friday. So we could see a good end of the week and hopefully see rates stabilize, continue to be stable, and we'll hopefully see lower rates into September. So good news there, and excited to finally see rates hopefully in the fives by the beginning of next year, maybe the end of this year, but probably earlier in the first or second quarter of next year, we'll see rate in the fives without any points. So any questions on interest rates, on what's happening in the market? I wanted to go over a little bit more about the NAR settlement. To be clear, any proceeds that are given to this by the seller to pay for the buyer's agent commissions are not counted in the overall total. So it's separate. So I want to make sure you guys know that. So you can get the full concessions of up to 6% on FHA, plus you can have the seller pay for your commissions. It does not impede on the max amount you can get from the seller for the max seller concessions for that loan program. So other than that, we are, yes.
Sorry, can you just repeat that one more time, because you kind of froze at the very beginning of it? Sorry.
Yes.
And I want people to really understand that. So
So the total concessions that you can receive from the seller for the loan program, and they're different for every loan program, those do not get affected by how much you're asking the seller to pay in commissions. That does not have anything to do. It's separate. So I want to make sure you understand that when you're looking at those charts on how much you can get from the sellers for concessions for different loan amounts, do not include the commissions that are being asked to pay for the buyer's agent. Do not include that in that. It's separate. You can go all the way to the maximum on your concessions for paying closing costs and points. And then the amount that you are asking to pay for the sellers, that's a separate entity. It does not get added to the amount on the total concessions for that loan program. So as an example, FHA allows up to 6%. You can get all of the 6% to get towards concessions for buying the rate down, paying all the closing costs. And then you can separately still ask for the 3% if you want to pay for the buyer's fees. So I want to make sure that's clear, because it was as clear as mud last time. But I did get some clarification on that so that we're not confused. It does not impede on the amount you can ask for the sellers for concessions for closing costs and buying the rate down. Any questions? I know I'm on a weird connection, and I apologize, but thank you for hanging in there. Any questions on what's happening in the markets or what rates are doing? I've got the chat board up there if you have any questions. All right, well, it's my mother's about an hour to come back to Arizona. So I'm going to be heading on a boat now, and I will see you guys tonight in Arizona, and I'll be back in the saddle. So I will be driving a little bit this afternoon. So if I'm not available, somebody on my team can help as well, but I'm always going to be able to answer the phone. So thank you guys. Enjoy your week, and I will be in touch.
Safe travels.
Thank you very much.
Thanks, Sean.